We're going to look tonight at the difference between stocks and bonds over time and how different interest rates can affect our investment over time. So first and foremost, if you look at the whole history of the stock market, and this is the history from 1926 to 2013, there's a company that went through and did all the research looking at the broad stock market and the broad bond market. So they took it was like a mutual fund, but different mutual funds over time. They took baskets of stocks and baskets of bonds, and they compared, hey, what does it look like if I invested only in bonds or if I invested only in stocks, the general market, for 1926 to 2013? Now, this is important to realize. This is almost 100 years. This study was done in 2013, so that's why it stops there. It would look pretty similar if it continued forward. If anything, the numbers would be slightly higher. But think about how big a time period that is. You go through the Great Depression, the 1930s. You go through World War II. I mean, think of the economy in the middle of World War II. The dot-com euphoria. So anybody remember the late 90s, early 2000s? It was like everything was going up, and then everything cut in half, or like maybe even further. And then the 2008 credit crisis. Anybody remember everything? Lehman goes under, all the credit-backed mortgages go under, everything tanks, the market cut by like about 40, 50% in about a year. That's the year that I graduated from college. And I was like, oh, wow, what a great time to go into the job market and try to find a full-time job. It worked out just fine. But actually, it's interesting, and we'll get some lessons from this tonight, but when I was looking at my investments for the first time in my 401k, I looked at the accounts that it was like, hey, you could invest in this and this and this. And this was 2009. Everything that I was looking at said that, oh, over the last 1 year, every mutual fund has lost money. Oh, over the last 5 years, every mutual fund has lost money. Oh, after the last 10 years, every mutual fund has lost money. So I'm brand new to investing. I don't know anything really that much about it. And I'm just for the first time, I've got a 401k I can put money into. And I'm like, well, why on earth would I put money into any of these accounts or any of these funds? Because they all lost money last year, over the last 5 years, over the last 10 years. I didn't know anything about investing. I mean, maybe a little bit, but it caused me to be afraid to jump in. And I didn't even know, I mean, I understood the market as a whole, but I mean, it's not like I've had 50 years of experience. So it's not that I was afraid of the 2008, 2009. It was more so that I just looked at the numbers and was like, who would put their money in something that's all negative? Does that make sense? Like if you're offered, hey, you can invest in this mutual fund, this one, this one, this one, they're all negative. I was afraid to jump in. What I wish I'd known, and I've pretty much figured it out within about a year, but I wish I'd known that was the bottom of the market. That was the best time to buy. And over the next 4 years, everything doubled back to where it originally was. And so if I had been purchasing right then and there, and I'm young, I have a first-time, full-time job with benefits, so maybe I'd invest $500 a month. But so it only would have been 1 year. It would have been maybe $6,000 that I would have put in, and maybe it would have doubled to $12,000. But then that money could have doubled again over the next 7 years, over the next 7 years, over the next 7 years. So the reason I want to educate is because even when the numbers look a little bit scary sometimes, actually that's the best time to invest. And I remember just looking at the numbers thinking, I'm not ready to jump in because I don't fully understand this. When really, if I had understood the broader market, I would have known, oh, this is actually a really great time to jump in. So if we go back to 1926 and you put $10,000 into a bond mutual fund, into just a broad-based market fund of bonds, what do you think would happen to that money by 2013? How much do you think that you'd have? And I'm just going to shout this out. The average rate of return over that period of time was 5.5%. So bonds average 5.5%. What do you think you'd have? Just $10,000, never put anything else in, just $10,000. Somebody has the notes. I love it. So by 2013, you'd have $1 million. If you just put $10,000 into the bond market in 1926, you'd have $1 million. Now that's what a 5.5% rate of return looks like. The same time period, and you can kind of see it here, it kind of goes along. It comes to about 250,000 by the 90s. By the time to get to 2000, it's maybe about 500,000. Well, I want you to now look at what that looks like with stocks. With stocks, going back to that same time period, the average rate of return was 10.2%. 10.2%. So what do you think that you would have if you invested from 1926 to 2013, just $10,000? I know now everybody's looking at their notes. But you'd have $46 million. If you only invested $10,000 and you just left it alone for basically 90 years, is that not crazy? All right, that's the difference between 5.5% and a 10% rate of return. On average, over the last 90 years, stocks have averaged about 5.5% rate of return. Again, that's good. That beats inflation. But stocks, if you have a diversified index fund over the course of 90 years, it's averaged 10%, and the compounding and the growth is really, really dramatic. You can see in this scenario, by the time you get to the year 2000, you're already over $10 million. And I think we were just getting to $500,000 with the bonds, and you're already at $10 million. So this is where the rule of 72 comes in. How many of you have heard of the rule of 72? So the rule of 72 is super helpful. This is a rule that shows you about how long it's going to take to double your money based on the average rate of return. So we just talked about a 10% rate of return for stocks. So 72 divided by the rate of return equals the number of years it will take to double your money. Let me show this to you. So if you go, I highlight it in orange, but if you look at 72 divided by 10%, the average rate of return, that means on average it'll take 7 years to double your money. At 5%, it takes about 14 years to double your money. So when we did the compounding, the doubling penny, part of what made it grow from 1 penny to $10 million in 31 days is that it was doubling. If we can have a general idea of how many years it takes to double our money, it can help us project and plan out really far into the future. Oh, well, if I start with $10,000, 7 years later, I'll have $20,000. 7 years later, I'll have $40,000. 7 years later, I'll have $80,000. So here's kind of the difference, 5%, 10%, and 15%. If you go from age 25 to age 65 or 67 in this scenario, and you go at 5%, it takes 14 years to double your money. So it doubles at 39, it doubles at 53, and then it doubles again by 67, so it's doubled 3 times. Again, you go to 10%, and it doubles at 32, 39, 46, 53, 60, 67. It is doubled 6 times, and so instead of having $80,000, you have $640,000. Are y'all seeing the importance of having a rate of return above 5%? And then if you go up to 15%, as you begin to look at the rate of return, 15%, it's now doubling every 5 years. And so it actually goes to $2.5 million in that same period of time. And it's not a guarantee, but this is a lot of the reason that people go into real estate, because real estate, if you manage it really well, can return about 15% a year on average over an extended period of time. But with real estate, you also kind of have a job because you've got to manage tenants, you've got to manage people coming in and out, you become a landlord, you've got to manage property, the property may need to be updated, you've got to paint it, you've got to sand it, you've got to do the roof. You might not do the roof, but you got to pay for insurance, and the roofer comes out and does the roof. So you kind of have a little bit of a job with where you're investing your capital. But the rate of return can actually be much higher, and if you were fully invested in something that got you 15% from age 25 to 65, And I mean, think about this. This is only if you put $10,000 in. This isn't adding $1,000 a month or $500 a month. It grows pretty dramatically. So the time you have, the time horizon or the window really, really matters. And we've talked about this. Time matters. If you invest for 1 year, it's too risky. If you invest for 5 years, there's still a risk. Think about when I graduated and started to invest in 2009, the 1 year window said everything was negative. The 5 year window said everything was negative. The 10-year window said everything was negative. So there are times in history where if somebody had started putting money in 1999 and they wanted to take it out in 2009, I think it was like 1% negative. It wasn't massive negative, but it was kind of like the money did not change hardly at all over that 10-year period. But if you had 20 years to invest and you could wait till 2020, then it would have actually averaged out to be about 10% a year. I mean, it's pretty incredible the longer your time horizon, and that's why it's important not to just plan to invest for 1 year. In fact, for 1 year, the volatility of stocks and bonds, you can see in the best year ever of stocks, it went up 54%. In the worst year of stocks, it went down 43%. That would be like a 2008, 2009 crash type moment. So if you go all in on stocks and you're like, great, I'm going to take it all out next year, man, there's a chance it could go good, there's a chance it could go bad. But if you plan out over a long period of time, bonds are less volatile. So the highest bond year ever was 32%. The lowest was negative 8%. So it is true, you can still lose money on bonds because bonds can still go up and down in value. But in general, the bond market is safer, and in general, it's a little bit more consistent and fluid with the way that it moves. Are y'all seeing that? All right, so let me give you just a quick example. This is kind of like, in my mind, and I guess it's kind of where I was way back in the day. You start in this place of, if you had $60,000 of an income and you just started to invest 10% per year, you take that, that's $6,000 a year, divide by 12 months, that's at a 10% rate of return. What you'd see is that from age 25 to 65, you'd have $2.6 million. If you go 30 to 65, you'd still have $1.6 million. If you go 35 to 65, you still have $1 million. This is just doing $500 a month from whatever age you start at. So again, I know that there's this place in the room where it's like, man, I wish I'd started when I was 25, but kind of give an oomph to the room of, hey, if you're in that age bracket and if you're beginning the journey, begin now, start the journey, start moving forward. Now is the time to begin investing, even if you just do a little bit by bit. 10% of your income starting early can massively compound. Now, this also goes back to something that I teach in the Getting Money Right class, and that's this concept of opportunity cost. So the opportunity to do one thing will cost you the opportunity to do something else. And so I like to think about it, like if I'm going to go out and buy ice cream, and I buy ice cream 2 or 3 times, it might cost me the opportunity to buy shoes. If you go out into the market and you're like, you know what I want to have? I want to have the newest, the latest and greatest, like brand new Ford truck. Literally, you can buy a truck these days for about $100,000. And this happens. I mean, this is fairly normal in Texas. Not fairly normal, it's pretty expensive, but this happens fairly often. If you took that $100,000 and you put it over 30 years, just by itself, into a long-term mutual fund that was based on the stock market, you'd have $1.8 million. So the opportunity to drive a brand new, really nice high-end truck also costs you the opportunity to have $1.8 million in retirement. It doesn't mean you shouldn't drive a nice truck. It doesn't mean that you shouldn't have nice things. I think there's place where as we grow our income and we grow in wealth and grow, it's actually incredible to have really nice things. But it's important to realize the opportunity to do this costs me the opportunity to do something else. Now, this is a big example. Y'all are like, well, I don't own a $100,000 truck. Like, that's crazy. And honestly, there's some folks in the room that for them, a $100,000 truck is actually right in line with their budget. And I want you to know, there are people at our church that drive a $100,000 truck, and I don't even bat an eye because I know it fits in their budget. I know it fits into their wealth management. But I want you to be thinking, hey, where am I at in my journey? And so I'll give you one that is a little bit closer to home for most people. We do this in the Getting Money Right class. Think about just buying a car. And you go with something that maybe is new, and it's a $500 a month payment. Or you get something that's 3 or 4 years old, so it's already depreciated about 60% of the value of the vehicle, and you buy it 3 or 4 years old, and your payment is only $250 a month. You're saving $250. You still get to drive about the same vehicle. It's a few years older, but you still have a vehicle that gets you to and from work. That $250, again, in the same scenario of setting it aside over 40 years in this example, from 25 to 65, becomes $1.3 million. So I just really want to put into our minds the opportunity of choosing one thing does cost us the opportunity to do something else. There's a financial podcast that I like to watch that it's got a guy, he's got a cup on his desk, and the cup says, like, this bottle of water cost me $88. And he's riffing on the fact that if he had invested the $3 that it cost him to buy the bottle of water, if he'd invested that over 40 or 50 years, it would have doubled and doubled and doubled and doubled and doubled. The opportunity to buy the $3 bottle of water cost him $88 based on his ability to invest. Are you guys seeing the importance of compounding, seeing the importance of having a plan? This is why it's so important to have a budget early on in the journey, because if you don't have a budget, what happens is you start to go through and you're like, oh, I can afford a $500 a month car payment. And then let's say your income goes up and it goes up really fast and like, oh man, that's amazing. Then you're like, well, I can afford a $100,000 truck. Yes, you can afford it. And yet you've got to look at this question mark of, okay, but if I'm not investing 10 to 15% of my income now for the future, this vehicle may be costing me the ability to retire with dignity 20, 30, 40 years later. Does that make sense? All right. So, personal example, again, we had one at $60,000 a year. Imagine you make $83,000 a year. And you've got to the place where you've paid off your debt, you're living on a budget, you're very content with your lifestyle. You begin investing 15% a year. That's $1,000 a month. So you go $1,000 a month at a 10% return. I mean, this is crazy. If you were able to do $1,000 a month from age 25 to age 65, that's $5 million. If you go from 35 to 65, it's $2 million. If you go from 45 to 65, again, it's $700,000. This is not a bad day. And if you take into account that most people live into their 80s, and if you can choose not to touch that money right away, you work just a little bit longer, you could leave it invested for another 7 years, and at 10% a year, it would double. You leave it invested for another 7 years, and it would double again. So that $700,000 could turn into 1.4, could turn into 2.8. All right, this is another fun example. Let's just say you made $150,000 a year. So someone makes $150,000, they put in 15% per month. That's $1,800 at 10%. This is always just fun to me. I'm like, wow. If you only invested that $1,800 a month for 20 years, and then you stopped entirely, but you let it grow until you were age 75, it would be worth almost $9 million. So do you see the importance of starting as soon as you can and investing what you can? I know I went from $60,000 a year and $500 a month to $150,000 a year, but I want to show you some of these numbers get crazy if your income grows over time and you're able to save consistently and aggressively. So let's talk a little bit about where you would choose to put your money in different seasons of life. So this is called asset allocation. And the general rule in the investing industry and modern portfolio theory is called the 110 rule. So the 110 rule says that you take the number 110 and you subtract your age, and that is about the percentage of stocks that you should be invested in. Because we talked about stocks versus bonds. Stocks grow more aggressively. Bonds grow slower, but they also don't go up and down as much in market crises. So if you're 20, it says you should go 110 minus your age, 20. You should be in about 90% stocks, about 10% bonds. If you are age 60, you should be in 110 minus 60, about 50% stocks, 50% bonds. Now, the reason for that is because let's say that you are turning 65 in the year 2008, and the market is about to cut in half. Well, it would be great to have some bonds in your portfolio along with the stocks that are about to go way down. Well, the bonds could help balance that out so that you don't have a massive financial shock right when you're retiring. Does that make sense? That's why they start to balance in more bonds. Now, if you're turning 65 and you enjoy your career, or maybe it's not even your career that you love, maybe you're just like, okay, I'm ready to retire from this, but I could earn $40,000 a year doing something else that I like, and I could live on, the $40,000 plus $2,000 a month from Social Security, plus maybe a little bit of savings that I have, and you could wait for 5, 6, 7 years for the market to recover, then you maybe don't have to be as invested as bonds. You could have a longer time horizon, and you could actually plan out, no, I'm going to stay more aggressive in stocks because stocks go up faster over time. Does that make sense? All right, so a lot of this is personal to where you are in the journey and what you enjoy doing. I kind of lean, and this is very aggressive, but I kind of lean towards 130 rule instead of the modern 110 rule. Like at age 30, I wanted to be 100% in stocks. Because in my mind, I want to capture as much of that movement up, and I understand how the market works. So if it had cut in half, then I would be like, you know what? That's all right. I'm still in it for the next 10, 20, 30, 40 years. And if it had cut in half, then I would actually be buying again at the lowest. So if it had cut in half in my 30s, it would have been painful because let's say I had put $10,000 in. Well, now I have $5,000. Let's say I put $50,000 in. Well, now I have $25,000. It's kind of painful. Like, where'd all that money go? But if you understand the market well enough and the recovery that's gonna come, then you actually are like, oh, this is great. Every bit that I'm putting in now will have the chance to double and double and double and double. And so in this scenario, you could get to age 60 and still be in 70% stocks and only 30% bonds. But again, by the time you get into your 60s or getting into retirement, you really want to start to look at your portfolio and say, hey, maybe it is time to add more bonds. Maybe it is time to slow down just a little bit because I don't want the market to go crazy up and down. Now, another really important thing that you have to realize is that I had that fear of jumping into the market based on the past performance that I was seeing in the mutual funds that I had offered to me. Now, there's another risk that most of us don't think about. We kind of think about, oh, I'm going to invest in stocks. What if the money goes down? One thing we don't think about is that if we don't invest and we just leave the money sitting in cash, inflation starts to eat away at the value of those dollars. So inflation averages 2 to 3% per year. In fact, the Fed aims for a 2% inflation. And some years it's 3%. The past 5 or 6 years, we had a crazy swing of 7%, 8%, 9%. It was very painful. I'm sure most of you experienced it or noticed it in some extent. But on average, it's 2 to 3% a year over the course of 10, 20, 30 years. So if you look back to 2005, this basket of just oranges, bread, chicken, electricity, eggs, gasoline, it would cost you $8.65. The same exact goods in the year 2025 would cost you $20.92. So if you had just left $100,000 sitting in cash in the year 2005, it would effectively be worth less than $50,000. You'd still technically own $100,000, but what you could buy with it would have gone down by about 50%. So if you're afraid to jump in and invest, if you're afraid to put your money into businesses or into real estate, If you're afraid to start investing, actually what happens is over time, the money that you're holding on to starts to slip away anyway. Does that make sense? There's two big risks in investing. One is you may lose some money. The other is that you don't do anything and you lose money anyway. All right, now as you jump into the market and you begin to allocate some money into stocks and some money into bonds, or let's say you go some money into big companies, medium companies, small companies, if you put your money out and diversify it well, some mutual funds will go up in value, some will go up really fast, some will go up a little bit. And over time, you may go from starting out at, I'll do 25% large cap, 25%, I'm supposed to say medium cap. I'm not going to fix it now, but I'm going to fix it later. So medium, 25% medium, 25% small, maybe you go 25% international. Well, over time, some of those may go up and some of those may go, not even down, they just don't go up as fast as the others. And your portfolio balance gets out of balance. So a general principle is about once a year, you go in and you rebalance your portfolio. What this does, and you can do it automatically if you're in a brokerage, it's pretty easy to just click the rebalance button and it goes back to your original target of, in this scenario, 25, 25, 25, 25. But what it does is there's some that went up a lot really fast. Well, what happens is you're selling those when they're going up. And if there's some that went down a little bit, well, you're actually buying more of those because they were down, causing you to have less of them. Great, you buy them while they're down, and you fill that bucket of your portfolio back up a little bit. So rebalancing automatically helps you sell some of your winners and buy some of your losers so that over time you're buying low and you're selling high. It's not like a perfect magic fix-all for buy low, sell high, buy high, buy low, sell high. It's not a perfect fix-all, but it does build that discipline into your portfolio. Yeah, Solomon? Yeah, so in a mutual fund or an index fund, what this would actually be in is it would be in maybe it's a retirement account or a brokerage account. In that account, you might buy 4 different kinds of index funds or 4 different kinds of mutual funds. And some will go up a little bit more than others. And if you want to keep your original balance of those 4, let's say you put in 10,000, 10,000, 10,000, 10,000, well, one may become 15,000 while the other became 8,000. It rebalances to where you go 10, 10, 10, 10 again. Does that make sense? Okay. So another really important thing, and we're going to get to a culmination here in a minute where we can actually go and look at some of this, but it's important to realize the cost of fees and how fees affect. Because we talked about if you're mutually funding, you're all putting money in, we all put our money into this investment or into this mutual fund, well, now we got to hire a manager to go manage that money, and that manager could cost 1% a year, they could cost 0.5% a year, they could cost 0.25% a year. Different mutual funds, different index funds have different fees. What I want to show you is that 1% in general in the industry is a high fee. If you go back 10 to 15 years, 1% was actually not high. 1% was pretty normal. But because the market has gotten so efficient and there are so many types of mutual funds out there, everybody's competing and driving the fees down, which is good for all of us. So now a normal fee might be 0.5%. And actually, it's pretty normal to get low. It's normal to have like a 0.25% or even ultra low, like 0.1 or less. So I'm hitting a few of these things, and we'll culminate them together in a minute. Another important rule for investing is the 4% rule. So the 4% rule says that it is safe to withdraw about 4% of your total portfolio in retirement and still be able to live on that over the course of 30 years. So this is really helpful because by the time you get to age 65 or 70 or 75 and you say, hey, I want to start to live on my investments for the rest of my life, how much can I take out? I can begin to withdraw 4% a year, and there's been a bunch of research and studies that go into it that say on average that money should then last you 30 years with no major problems. That means that if you had $1 million in retirement, every year you could take out 4% and you could live on $40,000. All right? What if you had $2 million? You could live on $80,000. What if you had $3 million? You could live on $120,000. I know 4 million is like, for some people, like, oh my gosh, that's crazy. But also, if you look back over history at the ability to grow, it's actually not too unbelievable. So let's go back to fees really quick for a second. If you look at how fees affect your account in retirement and in leading up and in building wealth over time, if you paid 0 fees, you just let the money grow at 10%, and in this scenario, it's an 8%, but let's say you put $10,000 at 8% for 40 years. If you had 0 fees, that $10,000 would grow to be over $200,000. Now, if you had a low fee, it would cost you $21,000 in fees on an account that you put $10,000 into. If you had a medium fee, it would be $41,000. And if you had a high fee, it would be $75,000. Now, that means that your end result would be $143,000 instead of the $217,000. So you might think, and I generally think, oh, you're only charging me 1% to manage my money? Like, that's not that bad. Like, I have $1,000, I give you $10. Okay, that's not so bad. I have $100,000, I give you $1,000. That's not so bad. But just like compounding doubles and grows based on rate of return, compounding again slows down if you lose a percentage point or if you lose a half a percentage point. So being aware of how much the money can grow is affected by your fees. All right, let me see. I'm going to go here one more time. We talked about this last week just for a minute at the end of class, but when you look at mutual funds and ETFs, you have actively managed accounts and you have passively managed accounts. An active account is where everybody puts their money into the mutual fund. We hire a manager, and that manager or that team of managers, their job is to go outperform the broad market. Their goal is to get a better rate of return than just a list of companies. On the flip side, there's a passive investment called an index fund, where literally you're not hiring a person to go beat the index. You just buy off of the list of stocks, and then you just follow that list. In an index fund that is passively managed, you're not paying an expensive manager. You're essentially paying a computer to go read off of the list and just go do all those transactions. So there still is a cost, but the cost is really, really low versus an active fund where you're going to pay a little bit more. So some good index funds or a good list is the Dow Jones Industrial Average. It takes about 30 of the most well-known large companies in the United States, and it's just a list managed by Dow Jones. There's a company named Dow Jones that just manages this list, and they just look at it, and they update the list every month. Hey, this is now one of the big 30. A year later, one fell off, one joined. Great. Well, you can hire a computer to look at that index fund and just buy those 30 companies off of that list. You could do the S&P 500. It's Standard and Poor's list of 500. So Standard and Poor is actually the last name of the guy that founded the company. Standard was another company that was a statistics company that tracked companies. Standard Company and Poor Company got together and it became Standard and Poor's list of 500 companies. Again, it's a statistics company and a credit rating company. All they do is look at who are the 500 biggest companies in the United States. It's a little bit more nuanced than that, but you can just think 500 of the largest companies in the US. Now, over time, that has averaged out to be in that 9 to 11% rate of return just off of the list. An active account is trying to beat that 9% or 10% or 11%. But if you just buy off of the list, you have extremely low fees and you're investing in the broad market of stocks and bonds. That make sense? All right, the Russell 1000 is 1,000 companies. The NASDAQ 3000 is 3,000 companies. There's something called the NASDAQ 100. and it's 100 large companies minus financial institutions. Why they chose to leave out financial institutions, I don't know exactly, but that weights you a little bit heavier into technology and 100 really fast-growing companies. So the NASDAQ 100 over the last 20, 30 years has averaged like 14%, whereas the NASDAQ 3000 has averaged 10% a year. Again, you want to diversify. You don't want to go all in one, but it's good to know that you look across 500 companies and you have a lot of options. All right, this is my favorite part, and where we'll have the most questions and most dialogue and engagement, all right? And some of it, I go off book a little bit here, and so just be generous as we go onto the computer for a second. We're gonna put all this together, because what I really want is you to see like, hey, where do I go to do this? What does it look like for me to actually go and buy a mutual fund or look at an ETF, or where would I find things that make sense? So here's the overall big recommendation is that you should be looking at something like a mutual fund or an ETF. So either one, they're about synonymous. And you should be, when you buy one, be looking at mutual funds or ETFs that hold more than 90 stocks. Like if you found a mutual fund that had 10 companies in it, I'd be like, you're not really diversifying that much. You probably ought to buy 100, you probably ought to buy 500. Then, when you're looking to make a decision, you want to look at a fund that has been around for more than 10 years. Because what do we say? 1 year, too risky. 5 years, again, risk. 10 years, 10 years is pretty good, but I actually want to find a company that's been around for 20 years or 30 years and has averaged 9 to 11% rate of return. That's what I'm looking for when I'm looking for a mutual fund or I'm looking for an ETF, is I'm looking for something that has a bunch of stocks in it. It's been around for more than 10 years, and it's averaging 9 to 11%, and the fees overall, I put competitive, but I like to look for low fees. Anybody want to look for low fees with me? So here's what we're going to do. We're going to go to Google. There's a bunch of great companies that you can purchase mutual funds from, ETFs, stocks. This is not an endorsement or a recommendation of any company, but I'm going to use this company as the first example for us to look. One nice thing about Vanguard is known for its low fees in the industry, and it's known as a mutual company, meaning that the people who are clients are technically owners. They don't retain a bunch of earnings and retain a bunch of profit. They actually lower their fees instead of retaining profits. So that's one nice thing about Vanguard, but we'll look at a couple. So if we go to Google, we just literally went to Google and typed in Vanguard, and I typed in mutual funds because we're looking for mutual funds. ETFs will come up as well. But I just hit that in Google. I scroll down. The first thing is Vanguard Mutual Fund List. And can y'all see this okay? I'm going to try to make it a little bit larger. All right, do you guys recognize stocks? Do you recognize large cap? We talked about large cap. And this is a blend, meaning it's a blend of growth companies and a blend of value companies. And so companies that are growing aggressively and then companies that might be a little bit undervalued. All right, take a look at this. The expense ratio is 0.04%. Is that high, medium, low? Ultra low. It's ultra low. Why is that? Well, because it's based on an index. This is the S&P 500. This is their version where they just use a computer to buy off that list. So a computer is making these purchases in those 500 companies. But let's look at this. Over the last 10 years, it's averaged 13%. Since inception, since the year 2000, and again, that was the year things were up and they came down. So it's averaged 8.3%. Now, because this is an index fund, this particular fund was started in 2000, but an index fund is buying off of that list. So its actual inception date would actually go back further to when Standard & Poor's was created. But Vanguard created this fund in the year 2000. All right, I'm going to scroll down because I want us to have a few different examples. All right, this is another one. And this is just the first thing that came up on their website. This is not like, we didn't plan this. We're just kind of scrolling through. All right, y'all recognize stock, large cap, again, a blend. It's growth and value. This is 0.41%. This is not an index fund. This is a select advice fund. This is a manager that's managing it. They're charging 0.41. Is that high, medium, or low? It's about medium. All right, looking at this. This has only been around for 4 years. All right, what's on my list? It needs to be around for at least 10 years, right? I'm not even going to look at this one. It may be a great one. It might be amazing. But I'm just going to go ahead and skip it because I'm going to look for funds that have been around for more than 10 years and average 9 to 11%. So now I'm just, instead of looking over here for a minute, I'm just going to scroll from when they started. I'm just going to continue to scroll down and look. All right, 2021, I'll make this larger. 2017, 2000, all right, 2000, but it's averaged 7% in the last 25 years. I'm going to keep looking. I'm going to keep moving. 2000, 2001, 1994, this has only averaged 4%. This is a tax-exempt California intermediate term fund. All right, that's not exciting to me. 4% for the last 30 years. All right, I'm still scrolling. All right, this is something. 11%. Again, it's over 20 years old. Let's scroll over. The fee is 0.35%. This is starting to hit. It's a low fee, 11% rate of return over 25 years. Are you guys seeing a little bit of how my brain is going through this? I'm not landing on this one and saying, hey, let's go buy it tomorrow. But are you seeing that that would be a pretty decent option? 11% for the last 20 years at a very low fee. This is an opportunity fund. Look, anybody familiar with mid-cap? It's mid-cap growth fund. It's focused on medium-sized companies that are focused on growing. Every time they make money, instead of giving dividends, they keep that money and they build another location, or they invest that into their company. All right, go ahead, Nathan. Closed, this is a Vanguard account that you can, I think they've maxed out how many they're selling of it. So we'll come back around, we'll find one that's not closed, but basically it means we couldn't get into it today. Yep, Abe? It's not showing up on here, but at the top, it'll let you filter by stocks, bonds, by what type of class you want to go into. We couldn't filter it because of the view right now, but that may have been, it was a California short term. It probably was a bond fund. What was it? It was a bond. It was a tax-exempt bond fund. So we'll talk about this in a minute if we have time, but your retirement accounts have tax advantages. Your brokerage account doesn't have tax advantages. And if you were looking for something that was a bond fund that didn't have a tax burden on it, then maybe you would buy that and say, hey, I'm willing to take, you would hopefully be thinking, oh, it might average 5% or 6%, but maybe over the last 10 years, it's only averaged 3%. But that's what would make it attractive is season of life and what you're looking for. That make sense? More or less? All right, we'll keep going. Hang on. Let's find one that's not closed. Let's go back. I like to start over here. Let's continue. All right, 1980, nope, 3%. This is a cash reserve. This is literally like being in treasury bonds. Like this is simply, it's federal money. So it's basically like putting it in federal treasuries. It's guaranteed almost, like it's not gonna go down, but you're only getting 3%. So if I'm investing for retirement, I'm not putting it here. If I'm saving for a house or if I'm saving for a truck and I want to guarantee that my money's at least matching inflation, then maybe I'd leave it here for a year or 2 years because you can see 3%, 2%, 2.8. This is the 1 year return, 5 year, 10 year, and maybe this is 10, 5, 1. Not sure what that is, man. That's year to date. But that's why they have so many options, because so many different scenarios. All right, we'll scroll down. Here's another one, 11% over the last 20 years. 0.09, very low fees. This is Consumer Discretionary Index. I'm going to open this one up because I want y'all to see the inside of one of these. So let's open this one up, not because we're like, oh, we have to do this, But just look at the name, consumer discretionary. So we're going to scroll down. It's domestic, which means it's not international. Again, the fee is low, almost in the basically ultra low range. Hang on, I'm going to zoom out so I can see. Let's go overview. All right, I'm going to zoom back in. It's going to show you the year to date. If you're investing for 20 years, you don't care at all about the year to date. You don't care at all about the 1-year return, the 5-year return. So just keep moving past that. Performance and fees. All right. This is again going to show us since inception, the performance again, 11.28, 12% in the last 10 years. We're scrolling down. Again, the fee is low. All right, hang on. We're going to come down. What I really want to show you is the portfolio composition. What's actually inside of it? So, %4 is in apparel and retail because it's a consumer discretionary fund. So it is investing in companies that appeal to consumers with discretionary money. If you have discretionary money, then you go buy clothes. You buy clothes, you buy automobiles, you buy luxury goods, you buy automotive parts for your car. We don't do this, but you might go to a casino and go gaming, computers and electronics, education services. Maybe you want to go back to school. Maybe you want to go to buy some Nikes. So what this fund is investing in is all consumer discretion type of companies. So all luxury, all automobile, probably even Walmart is in here. You go to Walmart when you have extra money, you want to buy something, you're a consumer. Let's see if we scroll down a little bit. Okay, now it will tell you what the top 10 holdings are. It's in Amazon, it's in Tesla, Home Depot, McDonald's, Booking, I think is probably like Booking Travel, TJX, maybe that's TJ Maxx, I'm not sure, Mercado Libre, Lowe's, Starbucks, DoorDash. All right, so when I look at the top 10 holdings, they don't tell you the whole list, because if they gave you the whole list, then you could create a computer index and just copy their managed fund. So like, hey, we'll tell you the top 10, but we won't tell you everything. But again, if I'm an average person looking at a fund that's done 11% for 20 years at a 0.09, very, very low fee, and what am I buying? I'm buying Amazon and Tesla and Home Depot and McDonald's. Like, this company's a little bit newer. I don't know if DoorDash is going to be around in 10 years. But I'm pretty confident Starbucks is going to be around in 10 years. So let's say DoorDash goes away, but Starbucks goes up. Great. Let's say DoorDash actually takes over, gets in, steals market share from Uber, and partners with Tesla and self-driving, and now DoorDash is happening all over the country, and it doubles and doubles and doubles again. DoorDash might be like one of its top 5 holdings. Or it could go away in 10 years. I don't know. But I'm not really nervous about owning a 1% of DoorDash and 1% of Starbucks, and 1% of Lowe's, and 1% of Home Depot. I feel comfortable when I'm in 100 companies, and I don't know, let's see. I want to see if did y'all see anywhere where it said how many companies were in this? Was it at the very top? It's usually at the top, and I may have just missed it. Fund number, further down, thank you. I missed it as I was scrolling through. Look, this is its goal. It's a low-cost index fund to U.S. stocks and things like retailers, restaurants, internet, direct marketing. It is well diversified. Maybe a little bit of marketing, but it's well diversified. And let's see. Let me know if y'all see it, because I'm just scrolling real quick. All right, oh, here we go. It's invested in 300 different companies. So if you buy this one fund, you now own a tiny share of 300 companies. And I told you guys in week 1 that I'm kind of a big deal because I own 500 companies, or at least a little tiny piece of 500 companies. You, tonight, can go to Vanguard, open up an account, just like you open up a bank account, you give them your information, you could go buy this, put $1,000 in, and you would own, that 1,000 would get divided into little tiny slivers across 300 companies, but you would own a little piece of 300 companies. That makes sense? Oh, look at that. You could not put, tonight, you cannot go home and just spend $1,000 and own this. I've told you guys this before. I'm glad that someone was paying attention. No. So again, what you would do when you go in, and this is Vanguard, but you can do this on Fidelity, you can do this on Charles Schwab, you can do this on Templeton, you can do this on Merrill Lynch, 100 different companies, but Google the top 5 mutual fund companies, or Google the top 5 brokerages. And what we could have sorted for, right now, I'd have to let me try zooming out real quick. There is a box at the top of this that usually comes up, and it's because it's plugged into my computer, that lets you sort it. And we could have sorted it to avoid closed funds, to avoid things like that have anything more than a minimum investment of $1,000. So you can go in and sort. But what I just want to show you is that as you go through these lists, and you initially look at the inception date, how the rate of return, the fees, and you know what it is, you can pop it open just like we did, and you can see what are the top 10 companies inside of this. So that's Vanguard. I tried to do Fidelity earlier today, so let's just go to Fidelity for a second because we're equal opportunity here. It was a little bit more confusing because it didn't just open up right to it. It sorts you automatically, but I guess the good news is, like, we're all familiar now with what domestic stocks and equities are, international, fixed income is bonds, index funds, large value, the blend, the large growth, the small to mid. So let's go and try to look at their small. We've looked at all large companies so far, I'm pretty sure. Let's look at small. Well, I'm clicking on it. I'm realizing now that I'm going to have to click directly into this one. All right, this is going to open up their low price stock fund. I don't know anything about this, but let's just zoom in for a second. All right, they're averaging 9%. One thing that killed me about Fidelity when I was on here earlier is I could not find the inception date. And it made, here it is when you get into the individual, but on the list, like how we were just scrolling through a list, it wouldn't show me the inception date on the list. And that drove my brain crazy because I'm like, I want to see it before I click on the stock. You have to click on each individual stock. But this is a good test case. Let me zoom in a little bit. All right. So since 1989, that's too much. It has averaged, let's see. Well, it's not going to show us on here what the overall average is. Somewhere on here it will, but over the last 10 years, it's averaged 9%. The fee is 0.89. Is that high, medium, or low? It's on the high side. But it's small companies, so they're a little bit more aggressive, and there's a manager that's actively looking at these small companies. What's cool here is it tells you right at the top. Wells Fargo, TD SYNNEX. I'm not sure how Wells Fargo is a small company, but P&G is not very small either. I'm pretty sure this reInvent. This did say small. It said, low priced. So this is probably a value fund. It's not a small cap. But it was in the small cap when I clicked on small cap. All right, sorry guys. This is what happens when you go like in the moment, and I haven't planned this in advance. But, here we go, the life. All right, so the life of this low price stock fund. So since 1989, it's averaged, I know it's blocking that a little bit so you can't see it, but it's averaged 13%. That's actually pretty darn good for 30 years. So 13%, it is benchmarking against the Russell 2000. That is a list, it's an index of 2,000 small to mid-cap companies. This is more information than you need to know. The Russell 3000 is 3,000 companies, large, medium, and small. The Russell 1000 is 1,000 large companies. The Russell 2000 is 2,000 medium and small companies. Are y'all tracking with that? So if you want to buy 3,000 companies at once, small, medium, and large, the Russell 3000. If you want to go smaller or larger, you have that option. So, now that I look at this, 12% over the last 30 years, it's a pretty great rate of return. I'm not saying we would buy this tomorrow, but it does tell you, all right, now my fee is higher, so instead of getting 12%, I would have only gotten 11%. But I don't know, I'm not offended by it, I'll tell you that much. And then, it lets you know what companies are in there. All right, so we could go to Charles Schwab and do the same thing, but I want to go back to show and tell a little bit, or back to communication and answer questions. So what's on your mind so far? What things are bubbling? Where did I go too fast? Where did I go too slow? What you got? So what does it look like if you had $100,000 and we dropped it into one of these accounts? You're talking about if we did that today, not if we did it back in 1989, but if we did it today, and we went to that consumer discretionary one that was 11% and only 0.09 fees, good setup. All right, you would now have $100,000 in that mutual fund. That mutual fund, I think, if I'm remembering right, had 296 companies in it. So your $100,000 would be divided out across 296 companies. What you would do, and I'm looking at you as this is personalized advice. This is not legal advice or counsel, but this is personalized, just general pastoral biblical counseling. as a handsome young guy with a huge time horizon, because you're so young, so good looking. Here's the thing: you would just let it sit there, and if the market goes up in the next year, great. If the market goes down in the next year, great. Because what you're planning is for Walmart and Amazon and DoorDash and whoever else was in there, you're planning for those 300 companies to do well in the next 20 and 30 years. So you would just leave it alone. I didn't get a chance to put it in the PowerPoint, but if you had an extra $500 a month to throw in, then you would do what's called dollar cost averaging, and you would throw in $500 this month, so you'd have $100,000 plus 500, and then you throw in another 500, and then another 500, and another 500. If the market was going down, you'd be buying it cheaper and cheaper and cheaper and cheaper. And if the market was going up, you're buying it a little bit more expensive. And past performance is not a guarantee of future performance. But if it does average 9 to 11% in the next 10, 20 years, 30 years, let's go 28 years, that's $100,000 over 28 years. If it averages 10%, your $100,000 7 years from now is $200,000. And then from there becomes $400,000. 7 years later becomes $800,000. So that $100,000 over 28 years, if it averaged 10%, you're sitting on $800,000 because you never touched it. And I'll go here for half a second, but I'll try not to spend too long on it. If you had that in a retirement account, an individual retirement arrangement, it has a little jacket on it, and that jacket helps you avoid taxes. And so if it was already in that account, it would grow and you wouldn't pay taxes on it. They might make sales inside, like they may sell off a couple hundred of those 300 companies and highs and lows, but every time they're selling and moving it, it doesn't affect you because you haven't sold the company and it's inside of your individual retirement arrangement, so you don't have any tax implications. I'm going to jump down for a second. If it's just in a brokerage, where it's not in your retirement account, your 401k, your 403b, your IRA, if you had just purchased $100,000, and we'd have to look at the tax implications on this individual mutual fund, but typically what happens is you don't pay taxes until you take the money out. And so if it goes up to $200,000 and you start to take the money out, then you pay taxes on the $100,000 increase. There are mutual funds that are more tax efficient, and there are mutual funds that they're buying and selling constantly, and that can have a tax implication depending on the paperwork inside of that fund. That was a lot of information, but did that answer your actual question? And if you did it through Vanguard, every year they would take out 0.09%. So out of 100,000, they'd be taking out, I want to say, $90. Is that right? I think $90, because 1% would be 1,000. So it'd be $90. So cheap. Like that's why it's ultra low fees. I like index funds with ultra low fees with a long track record. I personally am in the S&P 500 a lot. Go ahead, Nathan. I wanted to give you that context before I hit some of these retirement accounts. So an IRA is an individual retirement arrangement. If you don't already have one set up, and even if you do, you could set up another one, but you can only contribute so much. But you could literally go to Vanguard or Fidelity or Charles Schwab and click open account. It's like opening a bank account. You got to send them your ID. You got to send a lot of information in. But then you could click, I want to open an individual retirement arrangement. As long as you're earning money, you can put money into the IRA. Now, you can only put $7,000 a year in, but $500 a month, that's $6,000. So if you're just beginning to start, that's a great place to start. It's my favorite place to start because the individual retirement account, it'll give you two options. You could either be in a Roth IRA, and that means that you pay taxes on that money before you put it in the account. So this year, when you do your tax return, you're paying taxes on the income, and then you take what was left and you invest it. But if you do a Roth, you invested that money after you paid taxes on it, it grows from age 26 to 66, 40 years. And let's say it was only $10,000, that's a lot of time to double and double and double and double. You take the money out, and you pay no taxes at all if it's in a Roth IRA. So unless you make more than $250,000, it's not exact advice, this is general, but like if you're making less than $250,000, less than $200,000, then a Roth IRA is a really great place. You pay taxes on it today, but you don't pay taxes on it when you take it out. There's a traditional IRA, which is how it was originally built. That's why it's called traditional, because the first time they came up with it, it was the tradition of just, oh, you just pay taxes on it. The way it was built originally is you don't pay taxes on it today. So that money that you earn this year, instead of paying taxes on it, you put it in your taxes as the IRS doesn't see it. They're like, oh, great, you've shifted it into a traditional IRA. You don't pay taxes on that $6,000 this year. But when you take the money out and it's worth $1 million, then you pay taxes on the $1 million. So I'd rather pay taxes today when it's little than pay taxes when it's giant. Now, mathematically, it's actually equal. Mathematically, technically, it is equivalent, so it really matters what tax bracket you're in. But in general, I say do the IRA. Yeah, I'd have to spend 10 minutes breaking down the math, but just hear me say lean towards the Roth IRA unless you have a massive income. The nice thing about the Roth IRA is that it also, once you put it in, because you're paying taxes on it, let's say it was $6,000, well, you had to pay your 10% tax bracket or 20% tax bracket, so you had to pay an extra $600 or $1,000. So in a sense, even though you only invested $1,000, it's like you invested $7,000. And so it's gonna grow, and then you're gonna take that money out tax-free later. There's also a few other advantages to the Roth IRA in that you can take it out. You can take out what you've put in early and not have a penalty, whereas with a traditional IRA, you can't take out what you've put in without paying taxes and some other fees. The IRA will let you do $7,000 a year, $8,000 if you're over 50, and it's a catch-up. So real quick, if it's an employer account, they're 401ks, 403bs if it's a nonprofit. So a church would have like a 403b. A government program would be a 457 or a thrift savings. This is really nerdy. I think this is interesting. Nobody else here will find this interesting. But the United States has a code, the United States Code. I'd never heard of this before. It has 53 now, articles built into the code of the United States. In Title 26, there is a subtitle A, and in subtitle A, there's a chapter, and in chapter 1, there's a subchapter D, and in that subchapter, there's a part, and in that part, there's a subpart, and in that subpart, there's a section, and in that section, there's a subsection K. So it's literally in section 401, subsection K of the United States Code. That's where these names come from. They're coming from that section of the code. So to your point, with your 401k right now, and there's a still catch up as well, but you can typically put in $23,500 a year. What I would do is I would do both, because you can do both. Individually, you can do your own IRA, whether you're working for somebody or not. You can open up an IRA. You own it, you control it. You own your 401k as well. But you get to choose, am I going to do this in Vanguard, in Fidelity, in whatever you find the most comfort in. With your 401k or your 403b, it's going to be through a fund administrator. Sometimes the fees are a little bit higher, not dramatically, but maybe I had one where everything that I could find in my own IRA through my own brokerage that I chose was like 0.2, 0.3, 0.04, and everything in my 403b was like 0.8 and 0.9, or like of a percent. I mean, it was like 1%. It was 0.9. It was driving me crazy. It wasn't 0.09. It was like very high fees in mine. So I chose to max out my Roth IRA and then go into my employer-sponsored program. That was due to my employer's program, and I went to my employer about it a bunch of times. So I was like, guys, this is crazy. A lot of really good employers will have access to 1 million Fidelity accounts, a bunch of Charles Schwab accounts, a bunch of Vanguard accounts. And if you can get that Vanguard account through your employer, it's even, it's the same. So the nice thing is you can invest up to $23,000. So if you get a match, any kind of match with your employer, you want to start with your employer. Start there. Then, once you max out the match, I go over to the Roth IRA, fill it up, and then once I've filled that up, I come back to my employer and I fill up the rest. And that's what you want to do to overall balance out. Get the match, then do the IRA, that you get to choose everything you want about it. It's not stuck inside your company. Now, when you leave your company, you can roll all that money over into any retirement account that you choose, and you just do a direct transfer from that into that, where it doesn't come home to you, it goes straight into that account. And then you can manage it exactly how you want. Yeah, so a self-directed solo 401k, and this is like level 2, level 3. I didn't go into a simplified employment pension, a SEP. Like, you can actually, depending on your scenario, how many employees you have and how you want to structure it, there's a max of $7,000 on the IRA. There's a max of $23,000 on the 401k. But a solo 401k or a SEP, you could go up like $50,000, $60,000, $70,000 a year. So if you have a really good year in your business, you could set aside a huge chunk. And I mean, I was talking about numbers of like, hey, what if you set aside $1,000 a month? If you have a good year and you can set aside $50,000 one year because you own your own business, this class is about multiplying resources you already have. We'll have Kingdom Business coming up. But if you have the ability one day to go in and start your own business, you might invest $1,000 in your business, but get some clients and earn $10,000. I mean, that is like a 10x return. So small business is actually a way to invest and grow your wealth faster than 10% a year. But again, even if you own your own business, you don't want to put all your money, all your eggs into one basket. You still want to say, okay, I could take this extra $50,000, buy another truck, go do more jobs. Well, I'm going to take $20,000 and buy a truck. And I'm going to take $20,000, I'm going to go put it into a mutual fund, because over the course of my career, I still want to be diversifying across. That's not exact business advice, but just be aware, because you just never know what's going to happen even in your own company. So, good question. You don't have to. It's just a general rule that you can withdraw 4% and it will last for 30 years. And it's based on the Trinity study and a bunch of research. At age 70, depending on what type of account you're in, and we won't get into it here, but at age 70 and a half, they do, if you're in a retirement account, they typically require you to start taking minimum distributions. They require you, the government says, hey, we gave you all this tax advantage up till age 70 and a half. We need to start collecting our taxes. So you need to start taking money out and paying taxes on that. And so they will typically, at 70 and a half, it's like, it changes a little bit every year as you get older, but it starts around 2.5%, and then the next year it's 2 0.75 and then 3% and then 3.5. Like, it's very slow, but you are not required to do 4%. That's just a general rule of thumb that if you get to retirement and you've got $1 million, you should be able to live on $40,000 a year with no problem. Yeah, when do you get a professional investment advisor involved? I don't have a perfect answer for that. It is at your, part of this is to give you a comfort of when, if you do sit down with an investment advisor, when they say, well, I'll get you into some large cap and some index and don't worry about the equities, I've got you diversify. Like, when they start talking really fast and you're like, I don't know what any of that means, this class is meant to help you feel comfortable making a few decisions for yourself, but then also if you have $100,000 or $1 million or $10 million, like if I had $10 million, I'd be sitting down with an investment advisor. And I don't know exactly what that threshold is for each person. For some folks, it would be better that you pay somebody to help you get it done instead of sitting and waiting. We've all just seen that the sooner you start, the better. So I'd rather you pay 1% to somebody, but they actually help you do it. I'd rather you lose 1% but gain 10% a year for 30 years. So I would be, in general, with the average person, biased towards, hey, go meet with a professional advisor. That'd be my general advice. But then there are folks that have a deeper understanding. I'd be like, oh, you could probably wait till you hit certain numbers that there's going to be tax implications and better tax savings where you might start to sit down with somebody. If you just buy the S&P 500, like if you just bought an index fund at low fees that fit all those things, you would be in a great spot. Now, technically, you can make it slightly better by doing some other things. But if you just did that, you'd be winning. If you just did a target date fund in your 401k and you plan that target date for the year that you're planning to retire, that would be a good move. That would be a safe move. That would be what all of modern portfolio theory guides towards, is just a target date fund. And then inside of that one fund, it's just one thing. They go buy 1,000 companies and they mix it up between stocks and bonds, and they put you into more and more bonds the closer you get to retirement, so it's a little bit safer. If you just did either of those two things, you would be in a very good spot, and then you could specialize it further with a professional advisor. That make sense? All right. Thank you guys so much. Lord, I pray that you'll bless this room. Lord, as we talked about in week 1, the heart of being fruitful and multiplying, it came from you. Lord, it was your blessing on our lives to be fruitful and multiply. And so, God, I just pray that you would bless this room. You bless the people in this room. Lord, that I'm thinking of the scripture in Joel where it says that you even returned what the locusts had eaten. Every single one of us, Lord, has fallen short. Every single one of us have made decisions that we're not proud of. Every single one of us has missed the mark or not stewarded your resources to an A+ grade. And yet, Lord, you restore what the enemy has stolen. If we're just learning about this and just stepping into this journey and we're just beginning, then God, I just pray over each person in that scenario, Zechariah 4:10, Lord, you rejoice to see the work begin. Lord, you're excited to see the work begin in their lives and in their hearts. And God, you will restore what the locusts have eaten. You will, the 10%, man, it'd be great if we averaged 10% in our investments. And yet, Lord, you're our provider. It's not the investment account that's the provider. It's not the IRA. It's not the wealth that we may accumulate. Lord, if you alone provided food and a place to sleep for our families and meaningful work, Lord, for the rest of our lives, and we were able to bring some people home to heaven with us, that would be enough. And so, Lord, our heart isn't greed. Our heart isn't, oh, we need more. Our heart isn't, oh, well, I wish I could have $5 million, or I wish I could have $1 million. Our heart is to honor you, Lord, with every dollar that's coming in, to steward it well, to learn how to multiply, and, Lord, then to rely on you and look to you as our provider, and know, Lord, that you love us, and you're going to bless us, and you're going to multiply us in ways that are far more meaningful than physical dollars. So, Lord, I pray for blessing over each person in this room. In Jesus' name, amen.